In this video, I'm going to be showing you a very simple pattern that I used to make $4,000 in trading. If you stick to the end of the video, I'm going to show you exactly how you too can do the same and earn those big bucks trading just this pattern alone. You don't need any other pattern in trading. This is the most important pattern you need in trading. And I'm going to break it down step by step of how you guys can trade this pattern. So get your notes, get your pens, and let's get into the video. So we're going to be talking about the M and W formation. It's also called the double top and double bottom formation. So the M is the double top, the W is the double bottom. So I'm going to be showing you guys exactly how to use this pattern in trading and how you guys can understand and trade this properly. So what are they and why do they form? What are the M and W formations and why do they form? Number one, they are price action patterns that form when a trend is coming to an end and is about to reverse. So when you have like an uptrend or a downtrend and you get a double top or a double bottom, which is an M or W formation, then you can expect the market to reverse. You can expect that trend to begin to reverse, to change direction. They're used to identify trend reversals before they occur. So you can know if the trend is going to reverse before the trend reverses, right? So you can have an edge and begin to look for the opposite direction before the trend begins to go. So you can have like an earlier entry or tighter stop loss or something like that. 3, when traded, can give you tight entries. Like I just said now, that it will give you tight entries because you're entering before the reversal happens, and eventually it will give you a large room to profit. So if you can enter before the new trend starts or the new trend begins, then you have more room to make profit, right? And you have a larger room to profit because you'll be picking reversals at the tip of the highs and lows. That's basically the reason why. So here's a picture I got from Bitcoin. This is 2022. This is November 3rd, 2022. So you can see that before Bitcoin crashed from where it was at $69,000, that it formed this double top or M formation before it crashed, right? So we had this huge pump all the way up to $69,000, right? And then it formed the M formation and then dropped down. The trend reverse, so you can predict that the market is going to reverse before it actually reverses, right? So that's the reason for the M and W formation. And here's how the M and W formation works. It's based purely on price action and support and resistance. So we all know that the market consists of higher highs and lower lows, right? So an uptrend is made by forming higher highs and higher lows, right? And then a downtrend is formed by by giving us lower highs and lower lows. So here we have an uptrend, and we know that the highs are resistance, right? And when the high gets broken, it becomes support, and then it comes and breaks and retests it and goes like that. So we have an uptrend here, and then when the uptrend comes to an end, this resistance, we'll see that price forms a resistance, comes down, and then goes back up to that resistance or that high, and then fails to break the high, fails to continue the uptrend. That's a telling sign that the market is about to reverse, that the uptrend has lost its steam and it's about to reverse, right? So we can start looking for entries right at this area here. And then once the market reverses, it begins to break structure, right? So begins to form lower highs and lower lows. And the lower lows form supports, right? Till they refuse to break the support once more. Just the way they refuse to break the resistance, till they refuse to break the support, then we can expect a W formation for price to reverse back up. So how do we trade the M and W pattern? Number one, they form at the high and low of the day, high and low of the week, the month, or the year. So when you're looking for these patterns, you're meant to be looking for them at the high and the low of the day, of the week, of the month, or the year. You can't be looking for these patterns at the middle of the trend, right? So the ideal area to form the M and W pattern is at the high of the day or the low of the day. That's your best bet. That's where you can expect the market to reverse from, right? To reverse the trend at the highest point of the trend. That's where we expect the reversal. So at the lowest point of the trend, if it's a downtrend, that's where we expect the reversal back up, right? Buy the dip and sell high and buy low, right? That's the basic idea behind that. So number two, price breaks and closes above or below the 13 EMA to form the first leg. So when you have an uptrend, we're going to be using the 13 EMA to confirm the trend, to confirm the M and W formation, if it's valid or not. So without this 13 EMA, it's going to be a little bit difficult to find or to identify the ideal M and W formation. But we're going to be, in this video, we're going to be using the 13 EMA to find out which M and W formation is the best to trade, and that's what's up. So we're gonna once we have the uptrend, we're gonna expect price to close above or below the 13 EMA. What I mean by that is that if you have an uptrend and the market forms the resistance like this, right? Forms the resistance here and then comes back down like this, you have the 13 EMA around here, and it has to close below the 13 EMA. And once it closes below, it has to get back in and head towards the highs before it drops, right? And if it's a downtrend, then it has to close above the 13 EMA. 13 EMA will be near right here near the neckline, and that's what it's all about. So number three, price crosses back into the 13 EMA and heads towards the first leg of the high of the day or low of the day. So HOD means high of the day, and LOD means low of the day. So that's exactly what I explained here. It closes below the 13 EMA and then heads back up to the high. Here it closes above the 13 EMA and heads back to the low, right? So number four, price fails to break the first leg and forms candlestick patterns for entry, right? So we're going to be looking for candlestick patterns right at the high and right at the low, right? We're going to be looking for, so right here at the high, when the second leg comes back to the high, to the first leg, we're going to be looking for candlestick patterns to form here, and there are three candlestick patterns we're going to be looking for. The first one is the hammer formation, the second one is the railroad tracks or engulfing, and then the third one is the star pattern, the morning star or evening star. I think the morning star is the one that's in an uptrend, and the evening star is the one at the downtrend, something like that, or vice versa. I don't know. So and we're gonna enter at a close above or below the 13 EMA if no candlestick pattern is identified. What I mean by that is, if you don't get a candlestick formation here, then you can wait for price to close, for the second leg to close above or below the 13 EMA. If it's an M, then you can expect it to close below the 13 EMA. If it's a W, then you can expect it to close above the 13 EMA. And that's how we enter the trade. So I'm going to be showing you guys examples. Let's look at a couple examples here, and so you guys can know what it looks like, what I'm explaining, and get a better view of it. So here's an example of a double bottom. So we have the double bottom right here, and then the second one right here. So jokes aside, we have the low of the day here, right? We have the low of the day, and then you can see this is a downtrend. The market's been going down, and then it forms the low of the day and then goes back up, closes above. You can see it closes above the 13 EMA. This is the 13 EMA, the red moving average is the 13 EMA. So you see price closes above the 13 EMA and forms the neckline, and then goes back down, closes below the 13 EMA, and then closes back above, giving you an engulfing pattern here, and we enter the trade right where it closes above. This is where we enter the trade at our entry, and then we take the price up, right? So here's another example of the same pattern, the W formation, the double bottom. We see the downtrend here, we see the 13 EMA, and we see the market forms the low of the day and then rises, closes above the 13 EMA, and then goes back down there to the low. Doesn't break the low, just respects the low, because the low is the strongest support you can ever get. The low of the day, the low of the week, the low of the month, the low of the year is like the strongest support or resistance you can ever see in the market. So we see price respect that area, gives us a railroad track here, and then that's our entry. We enter this on a buy, and we can see price shoots right up, and without even without pullbacks, right? So we get this pullback here. So here's an example of the M formation or double top, right? So we have the high of the day set here. So this is our resistance. We draw a box, then we wait for price to come back to this box, this area, and we can see price closes below the 13 EMA and then consolidates for a bit, and goes back up to that high. To the first leg, the high of the day, gives us a candlestick pattern which is called the railroad tracks, right? Railroad track. And then this is our entry. If we don't enter here on the candlestick pattern, then you can enter at the close below the 13 EMA, which is right here. You can enter on the close below here. This is also a good entry, and you can see price shots down straight. And here's another example which looks very identical to the previous example I just gave of the M formation, and we can see price comes and forms the high of the day, comes back down, closes below the 13 EMA, and we can see price goes back up to that high and throws wicks to that high, right? So just throwing wicks at that high, respecting the high. You can see how it respects. We draw a line from the high of the day across like this. You can see that these wicks are just respecting the high, rejecting the high. That's a telling sign that the market is respecting that place and is about to reverse. They don't want to break that area. And then we look for a candlestick pattern. We got a hammer formation right here, so we can enter the trade on the hammer, or if we don't enter there, you can enter on the close below the 13 EMA, and we can see that the market shoots down from there. So that's another example. So final example of the W formation. Here we have the downtrend. We have the market sets the low of the day with the hammer, right? Goes back up, closes above the 13 EMA, and then goes back down, heads towards the second leg, goes to the low, rejects that low with this doji here on this hammer, and then we can enter on this hammer, we can enter on this hammer here too, or we can wait for market to close above the 13 EMA, which is right here. And if you enter right here, that's a very good entry, and then you take the trade back up. So where you put your stop loss if you're entering this trade is below the structure, right? So if you have a second leg, you place your stop loss below here. On the second leg of the M, you place a stop loss either at the high of the day or above the second leg. If it's a W, then you can put your stop loss below the second leg, or you can put it at the low of the day, right? So that's basically where to set your stop loss if you're entering this trade. So remember to backtest this, and backtest this. Backtesting is the way you program your mind to know these patterns, to remember these patterns. So when you're trading live, you can easily identify those patterns when they come up on the charts, because that's what's gonna give you the consistency and the profitability in this market. So trade with discipline, don't over leverage, trade with proper risk management, don't risk your whole account on one trade, take proper risk and take screenshots, right? Take screenshots and save them. When you're backtesting, take screenshot of these patterns and save them, just where I gave you guys, just where I screenshotted all this and mark them up. You guys should make markups too. Take screenshots and save them so you can have them. If you can print it out, then that's even better. Print it out, then when you're trading live, then you can like put the screenshots or put the printed shots right beside your screen and see if it matches up with what you're seeing live on the screen. And then if it matches up, then that's your setup, and then you take the trade and see how it plays out, right? So this setup has like a 90%, 80 to 90% win rate. I've tested it myself and it works really well. So that's it for this video. Like and subscribe if this video really helped you, and then leave a comment, and I'll see you guys on the next one.